So you're getting into investing, right? Well, pretty quickly, you're going to hit this big fork in the road: index funds versus active funds. Now, these are two totally different ways to grow your money. And honestly, choosing between them can feel a little overwhelming. So in this explainer, we're going to make that choice crystal clear. So, what's it going to be? Are you the type who wants to just ride along with the market's flow in an index fund? Or do you want to bet on a star manager to try and outsmart the market with an active fund? Look, understanding the real difference here, that's your very first step to investing with real confidence. And that is exactly what we are here to do. We're going to break down how they work, what they cost, and most importantly, how they actually perform. By the time we're done, you'll have a really solid idea of which strategy is the right fit for you. All right, let's kick things off with the absolute basics, the core philosophy that splits these two funds apart. It all boils down to one simple question. Is the goal to match the market or to beat the market? Okay, here it is, side by side. An index fund, that's what we call a passive strategy. Its one and only job is to just copy a specific market index, say the S&P 500. The whole point is to give you the market's return, nothing more, nothing less. An active fund, on the other hand, well, that's run by a real person, a manager who's actively picking stocks, using their expertise to try and get better returns than that very same market. A great way to think about an index fund is, it's like a train. It's on a fixed track, that's the market index. The journey is predictable, it's reliable, and it's going to get you exactly where the market is going. No surprise detours. And best of all, the ticket, your investing fee, is super cheap. Now, if the index fund is the steady train, an active fund is like a sports car. You've hired a professional driver, that's your fund manager, to navigate the streets. The whole idea is to find shortcuts, weave through traffic, and beat that train to the destination. But of course, this car needs more fuel, which comes in the form of higher fees, and there's always the risk of a wrong turn or getting completely stuck in a jam. You might even end up arriving later than the train did. And that whole car analogy, it brings us right to a really, really important point of comparison: the cost. Because trying to outperform the market, well, that doesn't come free. And this is probably one of the biggest factors you need to think about. And it's a totally fair question. I mean, why is one so much more expensive if they're both just buying stocks? Well, the answer really comes down to all the human effort and all the resources it takes to run an active fund. You see, active funds have a ton of overhead. They've got whole teams of researchers and analysts whose job it is to hunt for the next big thing. They're constantly buying and selling stocks, which racks up transaction costs. And of course, that expert fund manager and their team, they need to get paid. All of this gets bundled into one fee called the expense ratio. And when you actually see the difference in that expense ratio, wow, it's huge. For an index fund, we're talking a tiny fraction of a percent. For an active fund, it can be 10, even 20 times higher. Now, that might not sound like a lot at first, but believe me, over decades of investing, that higher fee compounds and can take a massive bite out of your final returns. Okay, so we know active funds cost more. But do they actually deliver the higher returns that would justify that cost? This is the million-dollar question for every single investor. So let's take a look at the promise versus the cold, hard reality. The difference in what you can expect is pretty simple. Index funds promise you market returns, and that's exactly what they deliver, consistently. Active funds, though, they promise you the potential for more. But that outcome is totally uncertain. They might beat the market, sure, but they might just match it, or even worse, do worse than the market. And here's the crucial reality check. Yes, some talented active managers absolutely do beat the market in any given year. But study after study has shown that over the long term, the vast majority, we're talking more than 90% of them over a 15-year period, fail to beat their benchmark index, especially once you factor in those higher fees. So with all of that in mind, how on earth do you choose? This isn't about finding the single best fund out there. It's about finding the fund that's right for you, for your goals, your budget, and just how hands-on you really want to be. You might be a perfect fit for index funds if you want a simple, set-it-and-forget-it kind of strategy. If keeping your costs at an absolute minimum is your top priority and you're perfectly happy just earning the market's average return over the long haul, then yeah, index investing is an incredibly powerful and reliable choice.
On the other hand, you might lean towards an active fund if you've done your homework and you truly believe a specific manager has the skill to beat the market. Just know this path requires more work from you. You have to be willing to monitor the fund's performance and be okay with the higher risk that your bet on that manager might not pay off.
But remember this, it doesn't have to be an all or nothing decision. In fact, a really popular and smart strategy is to use both. You can build the core of your portfolio with those stable, low-cost index funds, and then maybe use smaller satellite positions in active funds where you think a skilled manager could give you an edge. Now, whichever path you end up choosing, there are some common behavioral traps that can mess up even the best laid plans. Just being aware of them is half the battle. Let's run through these real quick. First, avoid chasing last year's winners. Past performance is no guarantee of future results, and today's hot fund is often tomorrow's average one. Second, never, ever ignore the costs. Like we've seen, they are the single most reliable predictor of your long-term returns. And third, treat that promise of beating the market as a possibility, not a guarantee. Okay, so let's bring this all home. After looking at the goals, the costs, the performance, what is the key takeaway for a smart investor? It really all boils down to this one trade-off. Index funds, they offer you the market's return with near certainty and at a rock-bottom price. Active funds offer you the chance to earn more, but that chance comes with higher costs and absolutely zero guarantees of success. And that leaves you with one final question to ask yourself. Are you building an investment plan based on a strategy that makes you feel comfortable and aligns with your long-term goals? Or are you just chasing the hype of finding the next big thing? Your honest answer to that question will point you in the right direction. And finally, just as an important reminder, this conversation is for educational purposes only. All mutual fund investments are subject to market risks, so it is essential that you please consult a qualified professional before investing.